Have you ever felt like you're doing everything right, going to work, paying your bills on time, maybe even putting a little into savings, and yet retirement still feels like a finish line that keeps moving further away? Here's something most people never hear until it's too late. You don't need a six-figure salary to build a second paycheck. You just need $6 a day. That's it. Less than what most Americans spend on a morning coffee and a snack. In this video, I'm going to walk you through exactly how a regular person, we'll call her Maya, takes $6 a day, invests it over her working career, and turns it into a portfolio projected to grow past $950,000. Based on the historical averages of the U.S. stock market, that portfolio can generate over $3,000 a month in reliable, passive dividend income. And she does it without ever touching a day trading app or guessing which stock is about to moon. No jargon, no shortcuts, just a proven process. And it starts with understanding the one financial concept most schools completely ignored. Let's start with the basics. Because if you're like most Americans, the traditional school system completely failed to explain how dividends actually work. Quick reminder before we dive in. I'm here for financial education, not to be your personal advisor, so always do your own research. A dividend is simply a company sharing its profits with you. When a business earns more money than it needs to reinvest in itself, it can send a portion of that profit straight to its shareholders, the people who own a piece of the company through stock. You don't have to sell anything. You don't have to time the market. You just own the stock. The company makes money, and a slice of it lands in your account, typically every 3 months. That's the entire concept. It's not a side hustle. It's not a day trading strategy. It's ownership paying you back. Here's where it gets interesting though, and this is the exact moment many people get stuck. They stop at dividends are nice and never go one layer deeper. Say you put $2,000 into a stock paying a 3% dividend yield. That's $60 a year deposited into your account whether you do anything or not. Most people see that number and think, $60 a year? That's not going to change my life. And they're right. If that $60 just sat there, but it doesn't have to. Enter the dividend snowball. Healthy, well-run companies don't just pay dividends. They tend to raise them, not because you asked, but because the business grew and decided to share more of its profit. So that $60 this year might become $64 next year, then $68, then $73. Same shares, same original investment. This isn't a rare event. According to S&P Dow Jones indices, there is an entire category of companies known as dividend aristocrats. These are American businesses that have raised their payout every single year for at least 25 consecutive years. Some, known as dividend kings, have done it for over 50 years through recessions, dot-com crashes, and pandemics. It's a pattern baked into how they operate. Now here's the part that actually changes your trajectory. What you do with that growing payment. Every time a dividend hits your account, you have two choices: pocket the cash or use it to buy more shares. If you take the cash, your next payment stays roughly the same size. But if you reinvest it, you now own more shares. More shares means a bigger payment next quarter. That bigger payment buys even more shares. The cycle feeds itself. Let's make this concrete. Say you invest $2,000 into a stock trading at $20 a share. That's 100 shares, paying a 4% yield. Year 1, you earn $80 in dividends. Instead of cashing out, you reinvest, buying 4 more shares. You now hold 104 shares. Year 2, those 104 shares generate $83.20. You reinvest again. Because modern brokerages allow you to buy fractional shares, you grab about 4.16 shares, putting you over 108 shares total. Year 3, that larger share count generates over $86. Reinvest again, and you're at over 112 shares. You didn't add a single extra dollar from your own paycheck. The portfolio grew itself. And remember, in a real portfolio, both the share price and the dividend tend to rise over time, which means this loop doesn't just continue, it accelerates. Most major U.S. brokerages like Fidelity, Schwab, or Vanguard let you automate this with one setting, usually called a DRIP, a dividend reinvestment plan. Flip it on once, and it just runs. But here is the one massive catch most beginners miss. According to the IRS, you still owe taxes on those reinvested dividends every year if they are in a standard brokerage account. That tax drag is exactly why many Americans prefer to build their dividend snowball inside a tax-advantaged account, like a Roth IRA. So the mechanics are simple. You get paid, the payment grows, and the growing payment buys more shares. But there's a problem hiding underneath all of this, and it has nothing to do with picking the right stocks. It has to do with what your money will actually be worth by the time you need it. Make sure you're subscribed and hit the like button, because in the next section, we are breaking down the silent wealth killer, inflation. Most people make one massive mistake when planning for passive income. They pick a nice round number for their monthly goal, and they stop there. They never ask what that money will actually be worth when they finally need it. Let's figure out what a livable, bare-bones income actually looks like today. If you're a single person in a mid-sized American city covering just the essentials, rent, groceries, a car payment, utilities, and a tiny emergency cushion, you are looking at roughly $4,000 a month. It's not lavish. It's just enough so that if your paycheck disappeared tomorrow, the lights would stay on. So for $1,000 a month feels like the target, right? Except Maya isn't building this for today. She is building it for 25 to 30 years from now. And $4,000 won't stretch nearly as far by then. That's inflation, the quiet tax that erodes your money's buying power every single year. A loaf of bread, a tank of gas, a rent check. All of it costs a little more next year than it does right now. You barely notice it year to year, but stacked over 3 decades, the math is brutal. According to historical consumer price index data from the Bureau of Labor Statistics, the U.S. inflation rate averages around 3% annually. At that rate, for $1,000 today shrinks to the buying power of just $1,648 in 30 years. Think about that. The same amount of money that covers your entire life today wouldn't even cover an average one-bedroom apartment 3 decades from now. To beat that silent tax, you can't just save. You have to invest. If you want to see exactly how to build a portfolio that actually outpaces inflation, make sure to subscribe to Or Invest, because that's exactly what we're breaking down next. So the real question isn't, how does Maya get to $4,000 a month? It's, how does she get to whatever number will feel like today's $4,000 when she actually gets there? Run that math forward with average U.S. inflation, and you land closer to $9,700 a month. So, Maya sets her ultimate target to a clean $10,000 a month. This is where most beginner investors quietly sabotage themselves. Not because they pick bad stocks, but because they pick a target that was already outdated the moment they set it. They aim for what feels comfortable today, hit that number decades later, and discover it barely covers half of their actual living expenses. But the second mistake I see constantly? It's even more dangerous. It's chasing the highest yield on the market without checking under the hood. A stock offering a 9% or 10% dividend yield can look irresistible on your brokerage app, but sky-high yields are usually a massive red flag. This is what Wall Street calls a dividend yield trap, because a dividend yield is just a math equation, the annual payout divided by the stock price. If a company is struggling and its stock price crashes, the yield mathematically shoots up. You aren't getting a great deal. You're buying a dying company right before they cut their dividend entirely. Like the SEC constantly warns investors, a yield that looks too good to be true usually is. Maya isn't just looking for flat income. She's utilizing a strategy called dividend growth investing. She wants income that grows fast enough to outpace inflation, backed by blue-chip companies healthy enough to keep paying it for decades. That means she needs a filter, a strict set of rules to separate the attractive on paper from the actually reliable. And that filter is exactly what turns dividend investing from a risky guessing game into a repeatable wealth-building system. Here is exactly how it works. Imagine finally having a portfolio that pays your bills whether you clock in or not. One that doesn't care if you're on vacation, sick, or just totally done with the 9 to 5 grind. That is the ultimate American dream, and today, we're building it. Now, just a quick reminder, this isn't official financial advice. Always do your own research. But this is the exact blueprint a lot of smart investors use. It all comes down to 3 strict filters. Every single investment Maya considers has to pass all 3, or it goes straight in the trash. Filter 1. It has to pay her now. This is the dividend yield. How much cash the investment sends back relative to its price. A stock yielding 3% on a $2,000 position pays $60 a year, right out of the gate, without any growth required. Filter 2. The payment has to grow every year. This is the dividend growth rate. If a stock never raises its payout, it gets quietly devoured by U.S. inflation. A company growing its dividend at 10 to 12% a year is mathematically doubling that payment roughly every 6 to 7 years. Filter 3. The share price itself needs to appreciate. Because Maya is reinvesting her dividends to buy more shares, she needs those shares to actually be worth something down the line. If the price stagnates, the whole compound interest engine slows to a crawl. Pay now. Grow every year. Appreciate over time. Miss any one of the 3, and the math to $6,000 a month completely falls apart. Here's how Maya builds her 5-position portfolio, splitting her $6 a day evenly, about the cost of a fancy drive-through coffee, putting $1.20 into each pick. Pick 1. Vanguard High Dividend Yield ETF, ticker symbol VYM. This is the only exchange-traded fund in her portfolio, and it's there for a very specific job: stability. According to Vanguard's latest filings, VYM holds over 600 dividend-paying American companies spread across nearly every sector. consumer staples, financials, industrials, energy, and healthcare. If any single stock in Maya's other 4 picks has a brutal year, this fund is the reason the entire portfolio doesn't collapse. Based on recent market data, it pays a trailing yield around 2.8%, with a historical 10-year dividend growth rate around 6 to 7%, and annual price appreciation historically hovering around 8%. It's the anchor of the portfolio. It's not flashy, but it lets you sleep at night. That's pick number 1. But to hit that $6,000 a month goal, Maya needs serious dividend growth for her next pick. If you want to see exactly what she buys next, hit the like button and let me know in the comments if you currently own any Vanguard ETFs. We've got the foundation set, but a portfolio needs more than just one ETF to hit that $6,000 a month goal. Let's look at the individual American heavyweights Maya uses to turbocharge this strategy. Pick 2. PepsiCo, ticker, PEP. This one isn't exciting, and that's exactly the point. According to S&P Dow Jones indices, PepsiCo is an official dividend king, meaning they have raised their dividend for over 50 consecutive years. It yields around 3%, grows that pay out roughly 7% annually, and its share price has appreciated by about 6.5% a year over the last decade. In a portfolio built to run for 30 years, boring and dependable beats exciting and unpredictable every single time. Maya doesn't need every pick to swing for the fences. She needs picks she won't lose sleep over during a rough quarter. Pick 3. Costco Wholesale, ticker, COST. Costco is the exact opposite story. Its dividend yield is the lowest in the portfolio, under 1%, meaning it barely shows up as income right now. But its dividend growth rate is the highest of the group, historically averaging well into the double digits, and its share price appreciation routinely crushes the S&P 500. Costco is the pick that feels invisible in years 1 and 2. The payments are small, but a dividend compounding at that pace mathematically doubles roughly every 5 to 6 years. Maya doesn't need Costco to pay her today. She needs it to pay her a massive yield on her original investment in year 25. Pick 4. Johnson & Johnson, ticker, Johnson & Johnson. Every other pick so far touches retail or the broad market. Johnson & Johnson changes that by adding healthcare, a sector where demand doesn't shrink as the American population ages, it grows. It yields around 3.2%, with a dividend growth rate near 5.5% and long-term price appreciation historically hovering around 5 to 6%. It doesn't lead any single category, but it scores solidly across all 3 of our filters while giving Maya exposure to a massive industry none of her other picks touch. Pick 5. Realty Income Corporation, ticker, O. This is where the trade-off is right out in the open. Realty Income literally trademarked the nickname, the monthly dividend company. It carries the highest yield in the portfolio, recently hovering around 5.5%, with a slow but steady dividend growth rate near 2 to 3%. Its share price appreciation is the slowest of the 5 picks. That's the deal Maya makes on purpose. This is the income accelerator. It's putting real cash into her account right now while the other 4 quietly compound. It's the difference between a portfolio that feels dead for the first 2 years and one that feels alive from month 1. Pro tip for U.S. investors: because this is a REIT, the IRS taxes these dividends as ordinary income. So Maya smartly keeps this one inside a tax-free Roth IRA. Blended together, Maya's 5 picks average out to roughly a 3.1% starting yield, a dividend growth rate near 7%, and annual price appreciation around 7 to 8%. That combination, modest income today, aggressive growth every year, is the exact mathematical engine that turns $6 a day into 6 figures and eventually into a real monthly paycheck. But building this portfolio is only half the battle. If you want to see the exact tax-advantaged accounts, you should put these inside so the IRS doesn't take a massive cut of your dividends. Click the video on the screen right now, and I'll walk you through it. Let's put it all together, because a plan on paper doesn't pay you a dime until you actually set it up. And honestly, this takes less time than ordering DoorDash. First, Maya opens a brokerage account. You want a platform that offers commission-free trades, no account minimums, and fractional shares. Apps like Fidelity, Robinhood, or M1 Finance are perfect for this. Fractional shares are the secret sauce here. They mean Maya doesn't need over $800 just to buy a single share of Costco. Instead, she buys a sliver of it with her daily $1.20, and that sliver still earns dividends exactly like a full share would. Pro tip: If she opens a Roth IRA to do this, all those dividends she earns will be 100% tax-free at retirement, according to IRS rules. Next, she links her bank account and sets up an automatic weekly transfer of $42. That's her $6 a day, split evenly across her 5 picks. Vanguard's High Dividend Yield ETF, VYM, PepsiCo, Costco, Johnson & Johnson, and Realty Income. Same amount, same schedule, every single week. Then she does the one thing most beginners completely miss. She turns on DRIP. That stands for Dividend Reinvestment Plan. With one toggle, every dividend payment automatically buys more shares in whichever holding paid it. The entire compounding loop now runs itself, no matter how busy life gets. That's the whole setup. Open the account. Automate the transfer. Split it 5 ways. Turn on DRIP. 15 minutes. And you never have to touch it again unless you want to check in. So, what does a measly $6 a day actually turn into?